Uh, we are continuing the same discussion. Last week, I remember I discussed up to the debentures, actually the bonds. Under bonds, we discussed various types of bonds, especially zero coupon bonds and coupon bonds. And also, we looked at government bonds and corporate bonds. Under corporate bonds, we also considered debentures, commercial papers, and how to value a bond, the bond price, and the relationship between bond price and its return, basically the interest rate. These things we covered last week. Today, we are moving from that point onwards. Basically, we look at shares and other financial products that we can find in the market. Now, shares are also kind of a capital market instrument. It's actually a capital market instrument, not a debt instrument. As you see here, actually, it should be basically a capital market instrument. So I would rather call it a capital market instrument, or you can simply say it's a kind of a share. Now, shares are securities representing a portion of the ownership of a company. And for that ownership, you have the claim on company's earnings and assets. So if you are a shareholder, you are eligible to claim on the net income. Net income means company's profit and its assets. So those are some rights that the shareholder has because you are an owner of the that company, particular company. Shareholders, they are paid dividends, that is a percentage of the profit. So these dividends are actually the cash income for the shareholder. And one thing is dividends are not regular. In a bond, the cash income is coupon and the coupon payment is regular. For shares, the cash income or the dividend is not regular. You get some years you get a dividend, some years you're not getting any dividend. So it is an irregular cash income, cash payment. Shareholders are like, we call them as residual claimants. Residual claimants means in the case of a bankruptcy, shareholders, they do not have, the the their claims are not paid first because they are the owners of the company. So the owners must get their dues as the last segment of the recipients. Whoever there are like debtors, kind of debt holders, actually not debtors, debt holders, they are getting the priority compared to shareholders, because for the debt holders you have a liability, you have to settle it, so they get the priority. But other shareholders, they are becoming residuals. In simple terms, you get your payments as the last recipients. Shareholders have voting rights to influence the management, and I am sure the voting rights depend on the share holding that you have. If you are a major shareholder, you have a bigger voting, rights, or influence is much higher. If you are a minor shareholder or minority, you are just a shareholder, but you cannot make a significant difference. And there are different types of share instruments. These instruments I thought of covering because in some papers you see these questions. So we need to understand, we need to know what are these different types. So types of shares can be classified into various aspects based on their attributes, based on their features actually. So first we'll start with ordinary shares. Ordinary shares are basically standard shares without any special right or a restriction. So in a ordinary share, or if you are an ordinary shareholder, you are entitled to have voting rights, but as the shareholders, you will be paid last if the company is bankrupt. So it's very basically what I have already mentioned, the standard share. Non-voting ordinary shares means same as ordinary shares, but you don't have any voting rights. That is also a kind of a different instrument. Preference shares, these are with preferential treatments when annual dividends are distributed to shareholders. So in the case of a distribution of dividends, preference shareholders will get a fixed dividend and no voting rights. They get a fixed dividend. So in that sense, this preference share is having features of both a debt instrument or a bond or a share, both. So it's a share because you are getting dividends. It's a bond, you are getting a fixed because you are getting a fixed dividend, and also you don't have no voting rights. So preference shares, sometimes you call it as hybrid instruments. In some books, I have seen the word hybrid instruments. Cumulative preference shares means it gives the holder that the right, if the dividend cannot be paid in 1 year, that will be carried forward to successive years. So if you have a cumulative preference share, even if you don't get a share this year, you will carry it for the successive years. So the share will be paid as a cumulative, the dividend will be paid as a cumulative value in a later year. Redeemable shares means company can buy them back at a future date. You can recall, actually, you can buy it back. Right? So those are the most important types of shares. So out of these different types, the ordinary shares, the preference shares, and redeemable shares, you should have some, clear idea. I'm not saying others are not important, but these three are the most popular areas of questions in any exam paper. So the definitions, you should have some idea. So in a share, what do you get as your payoff? Or in other words, what is your income of a share? So there are two possible income streams of a share. The first one is dividends. As I said, payments, these dividends are made periodically every quarter to the stockholders, shareholders, but it is not regular. Can be paid periodically, 1 year or annually or whatever, but it's not regular. You don't have any guarantee that you will get dividend every year. Okay. So shareholders are eligible, but there's no guarantee for the dividend. So it's similar to cash income in a bond instrument. Yet what you get as coupons is very similar to dividends. Capital gain is coming from the price difference. As we know, the share can be purchased at a particular price and it can be sold at a particular price in a later date. So if you can sell the share to earn a price appreciation, which means a profit, it indicates a capital gain. Also, you might incur a capital loss because due to a price decline. Let's say you buy a share at 100 today, the price has gone down to 80 after 1 year. So if you sell it at that point, you gain a capital, you have a capital loss, not a gain. So depending on the trends of the prices, you might have a capital gain or a capital loss. Okay. Then if you look at the share prices, the share prices are determined in the share market, through supply and demand forces, or supply for shares and demand for shares. There are people who are willing to buy shares, who are basically can be termed as buyers, or people who are demanding. And there are people who come with a supply, which means who are the sellers of the shares. So through the interaction between the buyers and sellers, you will have a share price. Now, if a company has a long-term earnings potential, which means a company has a good future, then such shares will attract more buyers. If a particular share, let's say share A is, you see the potential. It's a big booming company. There will be profits. There will be a good time in the economy, and the company A will boom. A will do well. So it's a kind of a company with a long-term potential, long-term uh, potential for earnings. So such companies attract more buyers. So when more buyers are attracted by such shares, the share prices would increase because of the demand. If a company has a poor outlook, then people are trying to basically sell the shares. So there will be more sellers than the buyers. So that will result in lowering prices. So the outlook for the share will determine the current prices. That is the idea. So if you see a good potential, you demand, prices go up. If you don't see a good potential, you are not demanding that much, the prices would decline. Okay. Now, depending on the price movements, we name share market the two conditions of the share market. So the first one is the continuous rise in prices. There could be prices are rising upward. It's a trend. In a good time, the prices could go up. For example, let's say tourism sector is doing well, then the hotel sector will have rising shares. So that rising prices, you can call it as an upward trend. So if the trend is uptrend or upward trend, so if the trend is sustained, you call it a bull market. If you see a continuous drop in share prices, you call it a downturn trend. So that is a sustained downtrend, which you call as a bear market. So bull bear terms, you may have heard these terms. So if you see the term as bull market, so that refers to increasing or expanding share prices. If you see the term the bear market, that indicates the market is dull or there is a continuous drop in the prices. So people look at this bull market and bear market. So in a bull market, what will happen? People will basically sell, right? When the prices start going down, the people will start selling. If you see prices are going up, people will start buying stocks. So this trend in the market, whether it's a bull or bear, that will lead to the appetite of the investors. So investors would decide whether to buy or hold securities or sell securities depending on the bull and the bear markets. So that's all about share prices and the shares. And related to shares, we discussed some of the concepts, I think previous 2 weeks back. I hope you remember the share price indices, total return index, price earning ratios, market capitalization. Those things we discussed in a previous session. So you should have some idea about those concepts and the rough calculations of these, or the method of calculations of these variables. You have to have some idea. Okay. Then let's look at another instrument called unit trust. So unit trust companies we discuss under the financial institutions. If you can remember, we put it under financial intermediaries, unit trust. So unit trust companies are basically dealing in unit trust. So there is the instrument. So it's a collective investment. Unit trust is a collective investment, which means there is a large number of investors, and that investor is a pool, base is a pool, and their money creates a larger investment fund. You have small investment as a pool, and if you taken it together, that creates a larger investment fund. So this fund, the large investment fund, is divided into pieces. You call them as units. So each unit worth a certain amount of money. And when an investor is investing in a unit trust, people buy these units spending money. So you give money and get or purchase units. And these companies, when they have these units, they form a portfolio, as I said. They are not keeping these funds in idle. The unit trust companies, by forming the basically the portfolio through units, they invest these units in various instruments. So for that matter, there are fund managers. So fund managers, they use the money collected through these units to invest in different types of investments, assets. For example, they can buy equities, so shares, bonds, government bonds or corporate bonds, property. Even they can invest in cash market, which means the money market. They can buy gold or whatever. Any investment they can do depending on their investment guidelines as the unit trust managers. So what is the real income for the actual income for the unit trust holder? Basically, when these people are making profits out of the total unit fund, so that profit is distributed among unit holders. So you are getting some, return out of your investment if the investment is profitable. So if the unit trust makes profits, you get some cash back as a kind of a dividend. Okay, unit trust. So in Sri Lanka, we have number of unit trusts. Very thin, small market, but still, this is considered as an important financial instrument. Okay. Then let's look at some more instruments. Venture capital. So venture capital instruments are basically, I hope you remember we discussed venture capital companies. Venture capital companies have this product, venture capital. So it's money provided to seed the early stage and emerging growth companies. So venture capital is basically the money you put to support early stage company. You call them as seed companies or emerging companies who are at a early stage of the business cycle of a company. So in the first stage of the business cycle of the company, basically you are growing. You have the growth potential and you try to grow. So these venture capital companies are basically supporting the early stage companies, and people, venture capital investors, they buy shares in these companies, some companies with potential. So you call them as they are angel investors. If you remember, as I said in the previous session, these investors are basically angel investors, right? So this is one source of capital market funding for early startups, for the companies who are having some potential. So you provide funding for those companies, right? Then we move to another type of financial instrument, financial leases. So leasing, these leases, I think you have some idea. This is a very common financial instrument that you observe in the market. And there are actually two types of leases. One is operating leases, the lease which covers only a small part of the useful life of the asset. That is one type. And also financial leases. A financial lease is our focus here. So it's an agreement with the two parties to utilize a particular asset uh, up to a maximum part of its economic life. In a financial operating lease, you are trying to use it for a small part. But in a financial lease, you are basically using it for a maximum period. So you can define financial leases are accommodations provided by intermediaries to finance purchases of capital and durable equipments. So these financial leases are basically provided for capital or durable equipments. For example, to buy a machine, to buy a vehicle, to buy a plant, to buy a building, you can have a financial lease. So in a financial lease, it's an agreement as we can understand. There are two parties. You have a legal owner. You call them as lessor. And he lends the equipment or the, let's say, the factory to the lessee. Lessee means person who is basically using that asset. So for lessee, he makes the payment during that usage period to cover the principal and interest. Okay. So the owner, legal owner, he basically lends for a kind of a loan with an interest, and it is a kind of a loan for a period to utilize that asset, financial lease. So the lessee receives all the benefits from the usage of the asset, and also he incurs the cost. He has the benefits as well as the costs, right? Legal owner of the asset is the lessor. Lessor means who is basically lending money. Who he reserves the absolute ownership. You call it as absolute ownership. Why do you call it absolute ownership? Why do you call it absolute ownership? Until the transfer is done, he owns the asset. So when the last lease rental is paid, then the ownership can be transferred to the lessee. So when the ownership is transferred to the lessee, the owner would be the lessee. But that is at the end of the project period or at the end of the economic life cycle of the asset, right? So he has the ability to own that asset at the end of the agreement by settling the lease. So this is very common instrument. I think you may have some idea. And related to lease, there's another instrument called hire purchases. So hire purchase is an agreement. He agrees to pay for goods in part or a percentage over a number of months. So in a hire purchase is very similar to a lease agreement by looking at that. But in a hire purchase, you are basically have the option to own it. So in that case, these are termed as rent to own facilities. In UK, this is called as rent to own facilities. So you rent it, at the end of the period, you have the option to own it. So this is a method of buying goods through making installment over the time. And also these are mainly applicable for used items. So the hirer gets the possession of the asset as soon as the hire purchase is signed. But the ownership is actually transferred when he makes the last payment. Okay. In a lease agreement, the ownership is with the lender, basically the absolute owner. In this case, you get the ownership, but the transfer is done, or basically the full ownership will become when the last payment is done. So these are some facilities used in some markets to facilitate the acquiring of physical or capital items. So acquiring a car, acquiring a building, acquiring a machine, you can, basically enter into a lease agreement rather than obtaining a loan. So it's during the lease agreement, you operate it, you operate to own it at the end. In a hire purchase agreement, you basically have the option at the end of the period to have it or not. Okay. Then let's move to financial derivatives. This is an important part and also a bit confusing, a tricky part. Okay. Derivatives. So financial derivatives are basically the contracts entered by certain parties to deliver the asset in a future date or at a later stage. Financial derivative, simply you can think of in a way it is a kind of a contract entered by two parties, but the settlement, the delivery of the asset will happen in a later date. Or you can call it a financial instrument which is linked to another specific financial instrument. Let's say an indicator or a commodity, or through which a specific financial risk, you link it with another instrument. So this is derived from another instrument. That is the idea. Okay. What do you mean by another asset? There is an underlying asset in a derivative. Underlying asset in a derivative. So based on that underlying asset, you create a financial instrument which are used for the purpose of risk management, hedging. Hedging means for protection against financial losses, and also even for arbitrage between markets. Arbitrage means basically in two markets you can make a gain if the prices are different. Arbitrage is not a good thing. We are not encouraging arbitrage, but people can use derivatives for arbitrage purposes. Some are, basically dealing in financial arbitrage. So that is their main business. So the derivatives can be used for that arbitrage purpose also. But mainly financial derivatives are used for these two purposes, mainly the risk management and hedging against the losses. Why there can be losses? The financial prices could change. We know there are various risks: interest rates, market rates, exchange rates, risk. Likewise, there are various certain risks. So depending on the risk, there could be losses. How to minimize these losses? You have to have a financial instrument like derivatives. Okay? And these derivatives can be traded. Financial instruments are tradable. Derivatives are also tradable. Now, by trading these derivatives, you make profits or you make gains, and that profit is dependent on the market price of the underlying asset. I told you this underlying asset, the derivative is based on a particular asset. For example, a foreign currency derivative is based on foreign currency. Interest rate derivative is based on, let's say, a bond. So price of that bond or foreign currency will determine the profit. So the price, basically the market price, will determine the profit. Means the asset is basically the underlying assets, right? And there are various types of derivatives: forwards, futures, swaps, options. Those are the most common derivative categories. I repeat: forwards, futures, swaps, options. Those are the most popular financial derivatives. So let's look at these financial derivatives one by one with some differences. Try to understand their differences, right? So forward contract is an agreement to buy or sell an asset at a certain future time for a certain price. Forward contract is an agreement to buy or sell an asset at a future date for a certain price. So that price you enter or agree today. So you enter today. So on the contract maturity date, the delivery of the asset will take place at the agreed price. The agreed price you agree it today, irrespective of the price on that day. Okay. Let's say you intend to forward agreement today. You want to, let's say, buy foreign exchange in 3 months' time, and when you enter into a contract today for that future price, let's say you think your price is 180 rupees per dollar. So use that price today in the forward contract. In 3 months' time, your transaction will happens based on 180. Even the exchange rate has gone up to 181 or 82 or 79, doesn't matter. The transaction happens at the agreed price today. So it's a good way to hedge against the price variation. So through price variations, there could be losses that you incur. So you minimize that price variation through the through hedging into through entering into a contract. Okay, and these are traded in the over-the-counter market. So that is the most important feature of a forward contract. Forward contracts are used in the over-the-counter market, and foreign exchange transactions are very popular in the forward contracts. Why? You need to hedge against the foreign currency risk. So forward contracts are used in the foreign exchange market means the foreign exchange market is basically an over-the-counter market. You have dealers, you have the communication technology, you do the transactions in the over-the-counter OTC basis. So forward contracts are used in the OTC contracts to hedge against price variations by entering into a certain agreement today to buy or sell in the future date at a certain agreed price. Okay, I hope it's clear. Then futures contract. Now futures contracts are also very similar. If you read the definition, there's an agreement between two parties to buy or sell an asset at a certain time in the future for a certain price. So same. So what is the difference? Futures are basically traded on exchanges. You don't have over-the-counter for futures. So futures are basically happening through exchanges. So there are various futures, oil futures exchanges, commodity futures exchanges in the world. So in those exchanges, future contracts are happening. So in this case, the exchange is specifying certain standardized features of the contract. So that is important. In a forward contract, you might not have any standardized features. But in a futures contract, you have to have some standardized features. Why there are standardized features? They are traded on exchanges. Okay. So now, for example, you can have a specified commodity today, crude oil, and you want to buy, let's say, 10,000 barrels in 3 months. So when you buy those 10,000 barrels of crude oil in 3 months, the prices could vary. So you enter into the price today. You agree with the seller and the buyer. What would be the price for this transaction? So you enter into the transaction today and you execute it in 3 months. At the time of execution, that price doesn't matter. Compared to that price, you do the transaction based on the agreed price. So if you compare that agreed price with the current price on that day, there could be losses and profits, but still you are trying to minimize that loss by entering into a certain uh, future contract. So again, similar to forward contracts, these future contracts are used to hedge against market risk, hedge against the price changes. Okay. I hope it's clear. So these are very common derivatives in financial systems, forwards and futures. Mostly these are happening in the case of foreign exchange market, especially the forward contracts. Futures contracts are very popular in commodity markets, oil, let's say gas, precious metals. So there you have a strong futures markets. Then we have another type called options. Now options are basically giving some option to the parties to buy or sell a fixed quantity of an asset. Could be a commodity, currency, security, or any other. So in this contract, you have some option or the right to buy or sell the quantity, a fixed quantity of a particular asset. So options are in that sense two types. You have the call options, you have the put options. Call options means if you are the holder, you have the right to buy the underlying asset by a certain date for a certain price. So when you have call option, you have the right to buy the underlying asset by a date at a certain price. You don't need to stay until the maturity. You have the option to call it. That is the idea. Put option means the holder has the right to sell the underlying asset by a certain date for a certain price. You can sell it. You can sell it. Just give. So in an option, as I said, you have two options. Either you can call it. Call it means you can buy it, the underlying asset, or you can sell it by a certain date. So call option means you buy, put option means you sell. Now, when you enter into the contract, the price in the contract, you have to specify that price in the contract, whether it is a call or a put. That price is contract is known as the exercise price, right? That is the price you execute the transaction, or you call it the strike price. So there is a maturity date in the contract that is known as the expiration date or the maturity date. Now, these are actually giving some flexibility to the investor or the party to buy or sell your security depending on the price movements that you see, right? You don't use that price. You have entered into a price already. You use that price, and as a result, you are basically having some guarantee that you buy or sell at a fixed price. The price is agreed before. Okay. And these contracts are, or the options are basically traded on the exchanges as well as in the over-the-counter market. So that can happen in both cases, over-the-counter or could be in the over-the-counter or the exchange, right? So when it is traded in the exchange, which means you have some standardized features. In the exchange, in order to come to the exchange, you have to have some standardized features. So if you have standardized features, you basically do it in the exchange. Then swaps. Now swaps are very complicated financial instruments. Here I basically suggest, without confusing too much, you basically have to have some basic idea how it works. Okay. Now swaps are financial contracts to cover the risk by having contract in opposite to the underlying asset. So you have basically underlying asset is there now. So with that underlying asset, you have an opposite contract also. Or you basically exchange two products. Now, why do you enter into swaps? You enter into swaps because for the purpose of covering risk by having a contract in opposite to the underlying asset. Now, in general, there are two types of swaps. We have foreign currency swaps, or you call it currency swaps, and also there are interest rate swaps. Those are the main two types. Traditionally, currency swaps and interest rate swap. What is a currency swap? A currency swap is a contract to buy a foreign currency while having an opposite contract to sell same foreign currency in same quantity. Now, what do you do basically here? You have a contract to buy foreign currency and you have a contract to sell same foreign currency, maybe in another currency. So a foreign currency exchange or the foreign exchange swap or the derivative between two institutions suggests you are exchanging the principal and interest in one currency with another currency. I'll give you an example. So swaps are happening in local markets, in our market. Now let's say a foreign bank brings foreign currency outside. He brings foreign currency, but he doesn't need foreign currency, he needs rupees. What he's doing basically, he sells foreign currency to, let's say, to the central bank. The central bank buys foreign currency and the central bank gives him back rupees, domestic currency. Let's say 3-month swap facility. So in the maturity date, the person who taken domestic currency will return domestic currency and will get his foreign currency back. So there is some certainty you have your foreign currency back. So the central bank who took that foreign currency, maybe he is entering with another party for another contract, but it doesn't matter. At the maturity date, the foreign currency has to be settled to the owner. So that owner who has borrowed domestic currency, he returns domestic currency with an interest because he taken a loan. He has taken a loan in domestic currency by pledging foreign currency. So that loan you have to pay with a interest. That interest is called as swap points. Swap points. I'll type it here for your easy reference. Swap points. Swap points is the interest that you pay at the maturity, the difference. Okay. So what are the rates applicable here? For foreign currency, the foreign currency interest rate applies. For domestic currency, the domestic currency rate applies. So there is a difference, isn't it? The difference is the interest differential between the foreign currency interest rate and the domestic currency interest rate. So that difference you call it as a swap point. So here I have a diagram. I think it's a bit confusing. I'm not going to basically cover it, but this diagram is applicable for an interest rate swap. So in an interest rate swap, two parties agree to exchange interest rates. From one party, you give a loan at a fixed rate. So when you give a loan to a fixed rate, you have a risk. What is the risk? If the interest rates go up or down, you are basically making losses or profits because your interest is fixed. To minimize that, you enter to another contract with another party for a floating rate. Now here, if you look at this example, party A is currently paying floating rate. But let's say he wants to pay fixed rate. Party B is currently paying a fixed rate. He wants to pay a floating rate. Why? If you have a floating rate, you want to have a fixed rate to reduce risk. If you are having a fixed rate, probably you need to have a floating rate to reduce risk. How do you do that? By entering into an interest rate swap, which means you exchange the fixed rate with the floating rate, and the net result is each party can have a swap of their obligation. Okay, I know this is a bit confusing, I understand, but simply have some basic understanding about these products. So if you are not so sure, probably I can give you a simple definition. A currency swap is a contract to buy a foreign currency while having an opposite contract to sell the same foreign currency in same quantity where the maturity and corresponding parties may differ. Okay, but the currency position does not change, right? Does not change. So you enter into a contract to exchange two currency flows, dollars and rupees, or rupees and dollars. When you settle it with an interest, which means swap points. As I said, central banks are mainly use these currency swaps to accumulate foreign reserves. A commercial bank may use a currency swap to have foreign currency while minimizing the currency risk. Okay? So these are the simple ways of explaining a currency swap. Interest rate swap, let me explain in a layman or the very simple language. They are used to mitigate risk of interest rate change in the future. So this is a swap between a fixed interest rate and a floating interest rate in respect of periodical payment of an interest of a loan. So if you have a loan, and based on that loan, if you have two options, which means you have a fixed rate, you want to move into floating. You have floating, you have to pay it in fixed rate. So that interest rate swap will allow you to have that flexibility. Okay. Now, for example, let's say a loan is given at a fixed rate or a floating rate, depending on the market interest rate movements. So you have that option. Let's say after giving the loan, interest rate in the market may change, and lender or borrower is affected adversely. So in this case, borrower or lender can get an interest rate swap arranged with a financial institution. Let's say the loan is 10 million and you are granted at 10% to pay for 10-year period. Okay, monthly installment. 1 year later, let's say if interest rate starts falling below 10%, now the borrower is saying having some disadvantage. Why? You have a fixed rate, agreed. But the market rates are lower. Now what can the borrower do? He can agree on an interest rate swap with the financial institution to pay interest on the loan in the monthly installment at a floating rate. Floating rate. So the financial institution would pay interest component in the monthly installment at 10% rate to the borrower. Okay. Now, again, I know even the example is a bit confusing, but I really suggest just to have basic understanding. What do you mean by a swap? You exchange the underlying asset or two products in two opposite directions to minimize the loss, minimize the risk. There are two types, the currency swaps, which means you exchange two currencies to minimize the loss, or the interest rate swap, you exchange two types of interest, floating or fixed, to minimize your risk. Okay. And there's another type of swaps. Actually, these are, I told you, some traditional swaps. These swaps, credit default swaps, became very popular after the global financial crisis. CDS, you call them as CDS. They are designed to transfer the credit exposure of a fixed income product between two parties. Now, earlier we were talking about currency swap means about foreign currency. Interest rate swap means basically a loan interest. Credit default swap is basically applicable for a bond fixed income product. So what happens here? You, as the buyer of the swap, you are having a kind of another party. Let's say you are a buyer of a bond, you are having another agreement, arrangement with another party to reduce your risk. I think if you look at this diagram, you will get to know the clear definition. Right? Now, it is a kind of a insurance for an investor. Now here, let's say there's 1, 2, 3 firm. He buys a bond from ABC company. So this person buys a bond from ABC. ABC, let's say a private bond issuer, private company. So he buys. Now, after buying the bond, what he does is he goes to 456 bank and insures the bond and agrees to pay them value of the bond is ABC is defaulting. You buy this bond from ABC, 1, 2, 3 firm buys the bonds from ABC, and ABC goes to 456 bank and insures the bond. What is the insurance? If this ABC is bankrupt and they are unable to pay, defaulted, the 456 bank will pay to 1, 2, 3 firm. Which, let's say his bond value is 100. This 456 is insuring the 100. So in the case of a default by ABC, they can't pay 100. The 456 bank will pay the 100. So what is the income for 456 bank? They get a fee, usually a percentage of the bond. So the credit default swap ensures that they have some kind of an insurance in the case of a default. If the borrower or the issuing company defaults, the investors are safe because there is a backup plan. What is the backup plan? There is an insurer. The 456 bank in this case, they are the insurer. They basically support or providing a buffer guidance to the investor for their investment. So these became very popular during the global financial crisis, and during that period, another concept became very popular, structured finance, during the global crisis. Structured financial instruments, they are created from loans granted by financial instruments for the purpose of credit management purposes, credit risk management. In other words, helping to transfer the risk. Now, the structured financial instrument is basically created through a process called securitization. Securitization. So I'll go to that securitization quick, straightforward. So here in this slide, you have the securitization process. What do you mean by securitization? Here simply what happens, you take out the all illiquid assets. Illiquid assets means bad assets. Bad means defaulted ones, possible defaulted ones, overdue ones. And you take out these illiquid assets to another portfolio, and that portfolio, using that portfolio, you create new instruments to be sold to the investors. Let me explain the chart, the diagram, then you will understand. So let's say you have three projects, project 1, project 2, project 3. All are bad projects, which means investor or the borrowers are not paying. Let's say you give a loan, borrowers are not paying. So these are bad projects. So what you can do? Now, if you keep these bad projects in your balance sheet, you will report as NPAs. So your balance sheet is basically affected, not good. What you are doing? You create a new portfolio. In that new portfolio, you include this project 1, project 2, project 3. So in that case, this red circle is a securitized portfolio. So let's say you have 100 here, 100 here, 100 here. So you create a 300 portfolio including bad assets. Now the story is not over. Now you have taken these bad assets to the securitized institution. Actually, you call this as SPV. SPV. Special Purpose Vehicle. Special Purpose Vehicle. To the Special Purpose Vehicle, you transfer these bad assets. After that, you create new instruments using that bad assets. You can create new bonds or shares, share 1, share 2, share 3, likewise. And there will be investors for these shares. Now, these shares might be having high rates. Why? The risk is higher because these are backed by bad assets. So in that case, your risk is higher. So even there could be some investors who are willing to buy these bad assets if they are securitized. So through securitization, you pool various types of debt and you create a portfolio which can be sold to investors. So that process, you call it as a securitization process. So under securitization or the structured financial assets, there are two major types actually: asset-backed securities, collateralized debt obligations. Now, these two are very similar actually. By looking at the nature, you can see they are very similar. But in the process of operating, there are some minor differences. So both became very popular during the crisis. During the crisis, what has happened in the asset-backed securities, these are collateralized bonds, which means some possibilities there for the default. So you gather those bonds into a securitization process, which means a special purpose vehicle. And after getting those bonds into the SPV, you can create new instruments using the SPV and you sell those new instruments to the investors. Again, they are interest bearing instruments. As I said, those could be high interest rates because those are backed by some uncertain assets, or which means having some risk. Collateralized debt obligations means is a type of structured asset-backed security. Now here you have actually securities, bonds. Here you have loans. That's why you call it the collateralized debt obligations. So you can create an SPV by collecting all bad loans. So when you collect those bad loans and you create new assets and you sold it to new investors, that you call as a collateralized debt obligation. Now again, as I said, these instruments are complex in nature. So what you need to understand very simply at this stage, we are not going into details of the derivatives or structured finance. You need to know when there are uncertain situations, when there are issues in the financial system, when there is a probability of default, you can create these products as structured financial instruments. In a structured financial instruments, you transfer bad assets into a new vehicle or new portfolio, you call it as a special purpose vehicle. In the special purpose vehicle, you create new financial instruments, whether it is bonds or shares, and you sell those instruments to the investors. And depending on the underlying asset you take, there could be asset-backed securities which are based upon bonds, or there could be collateralized debt obligations which could be based on loans, synthetic investments, or syndicated or single loans brought into a large portfolio. Okay. To finish off, I have a couple of things here. The contingent convertibles. So these are actually again used in the financial crisis periods when the banks are having issues. So when banks are having issues, the issue is reflected in terms of capital deterioration. So if you are making continuous losses as a bank, you are having high NPL. NPLs are charged to the balance sheet, which means your net worth, capital, will go down. So when capital goes down after a certain level, you need to have some cushion to infuse capital. Now, what happens when capital goes down? Private investors will not, provide any support because they are afraid of the bank. They might think, okay, the capital going down, the bank will collapse. Even the government, they are very hesitant to support because the government support can be done using taxpayers' money. Governments do not have money. They have to get taxpayers' money to support the bank. So in that case, you have a problem of recapitalizing the bank. To recapitalize the banks can use COCOs. COCOs means contingent convertibles, which are used as equity. Or you convert, it can absorb losses by way of converting the loss into equity, or basically through a write-off. Now, related to contingent convertibles, the most popular thing is contingent convertible bond or enhanced capital note, which means you can issue a debt instrument as a convertible instrument to support the capital position. Let's say your capital is gone down after below a certain level. So that certain level is a trigger point. So when it triggers, you can simply issue a contingent convertible bond or an enhanced capital note to infuse capital. That money is only used to strengthen the capital position of the bank. So these are used in the times of financial crises. Otherwise, banks can, withstand, banks can tolerate any loss. But during the crisis time, the loss is high. A lot of NPLs are there, so you are in trouble. How do you basically cover the loss, cover the capital position? You issue a contingent convertible. Then you have another instrument called warrant. This is actually very similar to an option. So you can, basically understand this similar to an option. So in an option, you have the option to buy or sell a financial instrument. So in a warrant, you have the right to do so. There's no obligation. You have right to buy or sell. So normally an equity can be bought before the expiration of the contract if you have a warrant. So there are two types of warrant. The call warrant, which means you can purchase a specific number of shares at a specific price before the certain date. Put warrant means you can sell a specified amount of equities at a specified price before the stated date. So it's very similar and to an option. I'm not emphasizing this too much because you see this question in only one paper in the past papers, but you really need to understand not the warrants. You need to understand these few things. First, what is a future contract? Second, what is a forward contract? Third, what is an option? The broad definition, call option and put option. Then what is a swap? What is a swap? The definition, and there are two types of swaps, interest swap, the currency swap. And then relating to the crisis, and during crisis periods, there are two major instruments that you can use: credit default swaps and structured finance. Credit default swap means simply giving some assurance to the bondholders, right? Credit default swap. And the securitization or the structured finance is simply giving some assurance for the bonds and loans in the case of a default. Right? So those are the key financial instruments. And after this point, I have given you some examples. For example, the government securities in Sri Lanka. T-bills, what are their features and everything given in details. Then I have given you information on government bonds. So these are the main government securities used in Sri Lanka, treasury bills, bonds. So you need to read these slides because I'm not going to discuss each and every aspect of these instruments, but you have to have some understanding what are these features. So these treasury bills and bonds, you call them as, and even the rupee loans, you call them as local currency instruments. Bills, bonds, and rupee loans are considered as local currency instruments. Treasury bills are short-term instruments. Treasury bonds are long-term instruments, but tradable. Rupee loans are long-term instruments, but not tradable. That is the difference. Okay. Features, you have to read and see what are the features. Then we have some foreign currency instruments. One is Sri Lanka Development Bonds, SLDBs. So these are issued in US dollars for the foreigners and residents, Sri Lankan residents living abroad. So these are issued to raise foreign currency and issued based on foreign interest rates. For example, LIBOR plus a margin is the interest rate. Then we have another foreign currency instrument, Sri Lanka International Sovereign Bond, ISBs, or you call them as Euro bonds, if you remember the Euro bond discussion. So these are issued internationally in foreign countries in major currencies to raise money for the Sri Lankan market or for the purpose of our usage. And also I have given you a comparison between leasing and hire purchases. That is also you have to read and get some understanding. And I have included some of the past paper questions. So use these past paper questions to get some understanding. Now, I'm not going to actually discuss these in detail, the questions, because I understand we have a plan to have a revision session on a particular date in the month of October. During the revision, I plan to take these discussion into the exam past paper exams as well as some revision to the concepts, right? So I'm not going to have an entire revision of the course, but basically we will pick up some of the exam questions, papers, and based on those exam questions and papers, we will have a discussion on the uh, uh, concepts as well, right? That is the plan. So that is the discussion today. I plan to take a stop here, and I have shared you the payment and settlement systems. This part also I do not wish to discuss in the class because we have a time restriction also. Uh, we are given, some certain dates to finish the class. So in that sense, I'm not so sure whether I will be able to complete the discussion on these payment instruments. But what I have done, I have prepared a comprehensive note here for you to read. So every information is given here very clearly. And I also have a handout, separate word handout with all these payment instruments and innovations. I will share that with you as well. Then you can have a look into that as well. Probably, depending on the plan, I'll try to have a brief discussion at least on the last date. But if not, we will take up these questions at the at the uh, revision session. So in the revision session, I'll be talking about some of these instruments in detail by looking at the past papers. Okay, so that is the plan up to now. Let me see if I can have a time, then I will come back to this and I'll discuss. And in any case, I discussed some of these in our previous discussions. For example, I have covered these instruments in our discussions. For example, debit cards, credit cards, prepaid cards, these I have covered in our money discussion. And also some of the mobile banking techniques I have covered. The mobile wallets, remember I discussed these different types of pay, Apple Pay, Samsung Pay, Alipay. Likewise, we have covered that part as well. E-money, including e-money. And also digital currency, I had a discussion on virtual currency. There I took this question, if you remember, the decentralized digital currency and digital fiat currency, or centralized fiat currency and decentralized fiat currency. I had a discussion on that as well. But let me try to find out some time. And also RTGS system, I have covered. Lanka secure system, I have covered to certain extent. CDS, I had a discussion on the CDS. Lanka interbank payment system slips, I had a brief discussion. CITS, I had a brief discussion in the previous session, So basically here and there, I have discussed these concepts. So it's up to you, get these slides and look at these slides very carefully. And I'll try to find out some time to discuss. If not, that will be covered in the uh, revision session. Okay. And with that, let's conclude. I'm planning to have one more session before we wind up our session on financial crisis and safety nets. So that would be basically the last session, financial safety nets and the crisis. And I hope that to conduct that session maybe next week or it as a recorded session. I invite and I expect you to see at the revision session, which will be an interesting and worthwhile, useful session for you to attend before the exam. Because when you go to the exam, you should have some knowledge, practice on the exam questions, and also some of the discussions that we did not pursue to a deeper extent will be covered in this revision session. Okay. I'll take a break here and I'll meet you next week, probably, if not as a recorded session. All right. Thank you. Have a good weekend.